Welcome to FRK 311. Please note that this work carries copyright. Today we're looking at IAS 8, accounting policies, changes in accounting estimates and errors. A specific outcome. You should know and understand the criteria for the selection of an accounting policy as well as criteria for changes in the accounting policy. You should be able to account for and disclose all aspects relating to changes in accounting estimates and the correction of errors. In order to achieve these specific outcomes, you should be able to explain and interpret the definitions of IAS 8, explain a change in accounting policy and a change in accounting estimate, explain the characteristics of errors, account for changes in accounting estimates and correction of errors, and account for the tax implications relating to changes in accounting estimates and the correction of errors, and then finally, very important, be able to apply the disclosure requirements in practical situations of these two items. The purpose of IAS 8 is to prescribe the criteria for the selection of an accounting policy and prescribe the accounting treatment and disclosure of, firstly, changes in accounting policies, changes in accounting estimates, and then correction of errors. The reason we do this is to ensure consistent preparation and presentation of financial statements and to enhance the comparability of an entity's financial statements with previous periods as well as comparability with other entities. Accounting policies. Now we're not going to look at the number crunching and calculations of accounting policies, just the theory. Accounting policies are specific rules and principles used in the preparation and presentation of financial statements. These rules and principles are usually prescribed by the respective IFRS standards. If such a rule is not prescribed by a standard, then we have to use judgment. Now, this judgment will be based on requirements and guidance of interpretations dealing with similar or related issues, or if you can't find it there, then we'll look at the recognition criteria of the conceptual framework. And then the accounting policy will be developed by management. Accounting policies for similar items must be applied consistently within each period, as well as from one period to the next. This will ensure comparability of your financial statements, and therefore a change in accounting policy is not expected to occur often. Next, changes in accounting estimates. Now, due to uncertainties inherent in business activities, certain items that we find in financial statements cannot be measured accurately and therefore need to be estimated. Now, this estimation process requires professional judgment and it will be based on the latest available financial information. Examples are provision for credit losses and provision for depreciation, such as estimated useful life, as well as the pattern of inflow of economic benefits, in other words, depreciation. Now, an estimate may need revision when there is a change in the circumstances on which the estimate was based, or you receive new information relating to this estimate. A change in estimate does not imply that the error was made. This is very important. Accounting treatment. Changes in estimates are applied prospectively. That means it is applied from the date of change onwards. Also important, the date of change is considered to be the beginning of the current financial year. So therefore, if your financial year runs from 1 January to the end of December and your change in your accounting estimate takes place in October, then it is deemed as if that change in accounting estimate has changed at 1 January of that year. We are not going to adjust prior periods. We will just apply this prospectively from the beginning of the current year. Now, a change in estimate can affect current period of profit and loss, such as provisions for credit losses, or it can change affect current and future periods of your profit and loss, such as a change in the useful life of a PPE or a depreciation charge. When you have difficulty to distinguish between a change in estimate and a change in accounting policy, then you must treat it as a change in accounting estimate. Let's have a look at disclosures. If the effect of the change in estimate is material, then we'll have to disclose the following items in the note profit before tax: the nature of the change, the amount of the change, the effect on future periods, if it is practicable to estimate. If it is impracticable to estimate the effect on future periods, then we must state this fact. Now, a change in estimate that affects the current and future periods is only disclosed separately in the year of change. In future periods, we will just carry on as normal. Thank you.